Welcome to the Educational Zoom series where we explore different topics to gain financial literacy and achieve financial freedom faster. Today we have expert in taxes and self-directed IRAs, Dan. Dan, please welcome to the show and please go ahead, tell us a little bit about yourself.
Awesome, Deepa. So excited to be here, and I love your background. I love the West Coast. It's great.
Thank you.
Not as pretty in Austin, Texas. We were joking before that I think every other AC unit went out during the summer, and people are kind of slow playing it. So, like anything, location, location, location. I'm in a great location in Austin. So, if you see the crazy lights, just attribute it to Austin being weird or Halloween or something like that in the background. Yeah.
Got it.
But no, life is great, and it's wonderful to be with you again.
Thank you. Thank you. Uh, please tell our audience a little bit about your journey from Wall Street and how you are now servicing the self IRA sector.
Yeah, I mean, it's kind of wild. So, for our Gen Xers and older, you can see a whole lot of gray hair and not too much of hair anymore. But yeah, I mean, like a lot of us here, what'd you do? You went to a school, you went to a name brand school, you interned. My journey had me at Wharton for undergrad, trading equity swaps for Merrill Lynch.
Oh,
You know,
wow.
I joke if I did what I did on the debt side, we'd be on my island, like a real one, not like a Zoom, like a real island. But I probably would have caused a financial crisis. So, good for the soul, not so much for the pocketbook. And the net result is, I got tired of the cold, so found myself out in Arizona at Thunderbird,
Nice.
which is it a car? Is it a wine? Yes, yes. It's also a top-rated international MBA program. So
Really?
I was able to split time between the Bay Area, Greater Phoenix, Glendale, and then we were the last kind of intercambio, the last interchange with the a school in Guadalajara, Mexico. So
Nice.
awesome community. Met my wife. I heard I'm not the first guy to come back with a bottle of tequila and a wife and a whole bunch of good stuff. So Mexico was fabulous and will continue to be for me. And like anything, sometimes it's right place, right time. I found myself at GE, which in a wild way, I mean, it was only 15 years ago when GE, General Electric, was still considered one of the top companies in the world. So kind of how time flies. But once again, I was in a mix of business development with GE Capital, GE Real Estate, throughout North America and up and down the
Nice.
Americas. So getting my first taste of real estate. And then uh, probably in the early 2010s, had a few, I'd say, aha moments. The first of which was coming back to Austin, Texas. I like to say a decade before the rest of the world has, presumably come here. Second was I was co-best man in a wedding, and I learned. I asked, "Say, what do you do?" He says, "I flip houses." I'm like, "Interesting. What does that mean?" He said 15%. I got excited. And then you have kind of the big light bulb moment. He said, "Did you know you can use your retirement dollars?" And in my mind, sitting in the little office in Stamford, Connecticut, working for GE, having maxing out my retirement for the Fidelity Year 2040 fund, that didn't seem like normal to me.
Wait,
And I get
wait.
it,
Reel back. So you could invest in a flip with your retirement
Oh
account?
yeah, you can. Oh, get
Really?
ready. You can do a
Oh
whole
my
bunch of.
goodness. Okay.
You can invest as the owner of the property. So your IRA is the owner of the property.
Okay.
You can also be a lender. So if you've ever done a personal loan, or as it may be termed, a note, or I just kind of call it what it is, a hard money loan,
Right.
although it is usually backed by the real estate. That
Right.
was my initial IRA investment.
Oh my.
Um,
Okay. Okay.
Prior to this and concurrently, also, I was investing in bars, restaurants, a comedy tour. Haha.
Oh my gosh.
If you really want to lose money for a tax write-off, do a comedy tour. So that was quite the experience, to say the least. Nice little $1,000 tickets to write off, as I joke. But yeah, I mean, the net of it all, it seemed to come together. And sometimes it's location. As I have joked,
Right.
I mean, we came back here to Austin in 2011,
Right.
and I always have a view, for the other side of the tracks, the underdog, but also I see, frankly, much better return, whether it is a loan. So compliments to all my female entrepreneurs out there. I think this is a great, avenue and a mutual win-win out there. But then also from, you can always compare it back to that mutual fund target date fund. Even in today's market, when you look at the
Right.
true post tax from a high yield dividend. So I had this decade plus of Wall Street backing, reading
Mm,
research reports, et cetera,
right.
behind me,
Right.
but then seeing the reality, particularly whether it's tax advantage in an IRA or, fast forward a few years, learning about K1s and such. A tax is just due this past week. It's wow, I see some of our colleagues out there had a seven-figure gain, but also a seven-figure loss due to depreciation. You
Right.
know, good for them. It's legal. It
Right.
just takes a little bit of learning.
Right, right. Oh my God. Okay, there are a lot of golden nuggets over there. So, I'm still stuck on how to invest your retirement funds in alternative assets. Could you
Mhm.
please? So, most of us have W-2 jobs. Most of my limited partners, who the audience is for this show, have W-2 jobs. Can they invest their 401k funds with the current employer in alternative assets?
Yeah, great question. Generally speaking, no. So I'll
Okay.
preface to say there's certain plans, particularly if you hit 55, but more so generally when you're 59 and a half, you get more liberties. But let's say,
Ah,
we're talking to somebody mid-career W-2. Let's say
right.
this is your third company out of school. You've been there for 5 years. This current
Right?
401k plan, we'll call it Company C, you cannot
Mm.
move it into a self-directed. And when I say self-directed, I mean capital S, capital D, legally a different type of account. Not like, hey, I was in my Fidelity account and I self-directed to a different fund. No, none of that.
Yeah.
Very different. So the answer is no. But then, referencing here one of your LPs, he or she probably worked for company A, for a few years and then company B. So as long as you did not roll those accounts into your current employer, employer
Ah,
C's 401k,
right.
if they're still
Right.
sitting on the side, let's just call it with Fidelity and with Vanguard, for example, you can tap into that money and then move it to, once again, a capital S, capital D, self directed IRA account to invest passively.
Nice.
So, once again, is it legal? Yes. Has it been around for a while? Yes. It's been around for multiple decades. The IRS views this as just as another stop on the train. So I'll go back to our example. When you worked at Company A, maybe you had Voya or our friends in Texas, Insperity, one of the PEOs, et cetera. You had a small plan here,
Right.
and then when you left Company A, it naturally rolled as a rollover IRA into Fidelity. Once again, still pre-tax, still traditional. You're probably in some mutual funds. Government kind of doesn't care what you're in because, well, you haven't paid taxes, and your intention is
Ah,
probably
right.
not to pay taxes until you're in your 60s or 70s.
Right.
So I share all that from a tax and early withdrawal, which you're not going to do without penalty or fees. This is just another stop on the train. So I want to make that real clear to folks is that it is actually relatively simple once you are made aware that this world exists.
Got it. Got it. Thank you. So they can invest, but previous employers' 401k funds, which have not been rolled over into the current employer funds.
Yeah, that's the big thing I always. So if there's any, I'd say, takeaway, particularly folks as you're, we're getting towards the end of the year, flip flopping jobs, et cetera. Maybe folks getting back into the workplace after so many years.
Mm.
Yeah, you once you move it there, it's as if you've been working for Company C, your whole entire career, which
Right.
in kind you cannot then touch until you leave Company C.
Right. Right. This might be a question that you might not be able to answer, but I'm going to ask it anyway. Why do you think that is? Why do employers not want to touch, not want us to self-direct their 401ks?
Yeah, I mean, a lot of times it's from the employer standpoint, they want you to do your job, basically.
Right? Oh, so it's a distraction?
Yes and no. It depends on the culture and everything else, but generally speaking, an employer, whether you're small, but especially as mid-sized and larger employers,
Okay.
uh, I think there's different things these days from a culture and a benefit standpoint that they're focusing on for retention. The
Ah,
401k, especially as you're at a larger company, is almost a given, but then your options and what you go into, yeah, it's a little stock, little bonds, a whole lot of mutual funds. It's been like that for so many decades now. It's almost a matter of fact, and you sign up on day one. You choose your election, and then yeah, obviously when markets dip or some volatility, maybe you look once a year. But most people don't really look or frankly think about it till they leave their career. And especially if you're
Right.
making six figures, you're probably going to max out, which frankly is not the best tax strategy. But it's just what a lot of folks do, and it's kind of on autopilot. So from the standpoint of even if whether it's the CFO, the head of HR, they change who is your PEO, who is your provider for all the benefits, you're still going to have basically the same very limited set of offering, but that feels very common and warm and fuzzy to you and all of your peers in the W-2 world.
Got it. Got it. Is it more like mom just wanting to put the toys in front of you that are approved by her that you could play with any toy you want, but only these?
Yeah, pretty much. And you don't know that it's only squares and circles, that you can't, you can't do glow sticks, you can't do other fun little things here. It's just,
Right, right,
here's what you have, and here's, it worked for me when I was growing up, it worked for my parents.
right,
And it's like anything, set it and forget it, go with it. And at a certain level of life, particularly as you're working, as you have family, as you have such, this is something that's out of sight, out of mind.
right,
So even now, if you never look to see what are the true fees in some of these funds, or what's the true return vis-a-vis even passive real estate, let's say in the same tax bucket, uh, you don't really realize till frankly you're probably in mid 50s and you're about to retire, if you're that fortunate to even do so these days. If
right,
not, I would argue a lot of folks that have these accounts are going to punt, punt, punt till they really need it. And by that
right,
time, they're going to be in these accounts 20, 30, 40 years.
right, right. Got it. Got it. So going back to why the retirement accounts were created in the first place, what was the need? Was there a need and why were they created?
Yeah, so it came out of and I'll keep it high level here.
Please,
Just
thank you.
yes, tax law in the early 1970s. The most common transaction, I'd say two types. One is to use your qualified, aka retirement dollars, to purchase a rental property,
Okay.
which makes sense. That just to be clear, you are not personally staying in, your kids, your
Oh,
parents.
got it. Okay.
So
So
you
it's an
have to be.
investment.
It's an investment. It's a hands-off investment. And then in a
Okay.
similar vein, um, sometimes it's just easier to be a passive. You're one of 20 or 30 investors from a limited partner sort of view. So
Right.
this was just a spirit. Real estate was and still is today the most common asset that goes into these accounts. It was more, in my opinion, for what you can do with the dollars vis-a-vis, I'd say, contribution. Why I bring that up, kind of giving fast forwarding through history, in the early 2000s, the solo 401k, aka the individual 401k, came to light.
Okay.
This is for self-employed folks, and part of the reason is, well, I worked W-2 all these years. I still want to max out that 20-ish k. Well, sure, you can do that. Let's say you're a realtor. This is a great example. There's over 1.3 million realtors out there. Just like your W-2 buddies, that initial 20,000, 26 plus if you're over 50, you can set aside just like you would working W-2. In addition, there's also a match on your net earnings. So the solo
Right.
401k, which is nice, is even just say an individual under 50, you're still looking in the, if you're having a pretty good year and you're a career and you're a one-man consultant, a one-woman realtor, for example, you can end up contributing, lowering your tax basis by 60,000 in a year.
Oh,
So
nice.
there's it's like anything. Being self-employed, I feel, takes a little more risk than, going up
Right,
the
right,
corporate ladder,
right.
going into your corporate job. So I don't know if this was the true intention, but this is kind of how it plays out in the end.
Got
So
it.
folks that are in an established career, or if you're having a rock star year, I would suggest being aware of the solo 401k. And a final point, not knowing folks are going to hear this, absorb this. If you are self-employed, and we can talk about what that means later, to benefit from the solo 401k from a contribution, the account needs to be opened in the calendar year. You don't have to contribute in that year. So let's take 2022. I would strongly suggest to have that account open by December 10th, maybe December 15th. And then come tax time next year, you can say, oh yeah, I want to contribute for 2022. If you wait to January, you know,
Ah,
you
nice.
can't go back in time.
That
So
is a great point because, you don't usually get to what's your adjusted gross income and what's your
mhm.
tax bracket until the year is done. And if you plan for it and open the account, then if you want, you could invest retroactively, right? Is that what you're
Yeah,
saying?
so you can contribute in this
Right?
example, and also invest. Yeah, so from the contribution
In the
standpoint,
past year. Right.
yeah. So that's just for our
Got it.
self-employed friends. So
Got it. Got it.
yeah.
And to be clear, solo 401k is only for self-employed folks.
Yeah, and the very non-technical term is that you're doing stuff. So why do I share that? But the government, let's say what is not doing stuff. Day trading, not doing stuff. Collecting a rent check. You own 10 houses down the block. Nope, not doing stuff. Realtor, doing stuff. One woman, rock star consultant, doing stuff. Uber driving a little bit, Etsy on the side. That is, you're doing stuff. Even if you don't get a 1099, I think a decent rule of thumb is you're doing something that you're probably going to get a 1099 from,
Right.
basically.
Right. Right. Right.
From once again, doing stuff is a pretty good way. But the true rule of law is that you have the intention to be self employed. So, some folks towards the end of the tax year, like anything, a lot of CPAs will also say, it's that first sale is what really kicks off all these tax benefits of being self employed.
Right.
So
Right.
even if you have an idea and you're going to go heavy and leave your W-2 next year, for example, maybe you do a small consulting project, maybe you only charge $1,000. Once again, you can't do those crazy contribution numbers we were talking about, the 20,000 to 60,000s, but you can open the account in good faith this year. And then as you move to being a one man and one woman shop, and I'll preface that to say it's in this entity. It could be you or you and your spouse, but without W-2 employees. So it could be a husband wife team, for example, but don't just put an employee there. And a great thing I heard from one of my mentors, he said, it's great to have one employee or to have 20 or more, but 2 to 19, you're just giving yourself a whole bunch of headaches. And that somewhat applies here, particularly if you have been self-employed. Um, you're going to limit yourself what you can do in the retirement side if you do have, say, just one other W-2 employee that's not your
Got
spouse.
it. Got it. Got it. Okay. And one last question when it comes to solo 401k contributions. So I do have Etsy or drive Uber on the side, and let's say I made $2,000, not much, but that qualifies me. I get a 1099 and qualifies me to open a solo 401k. How much can I contribute into that account?
Yeah, so let's just say you're not W-2'd also. So just to be clear, you cannot double dip. So, I'm
Got
here.
it. Got it. That's where I was going. Okay.
So
You
let's
cannot
say
double dip.
I
Okay.
work at Dell and I max out, and the once a century it snows in Austin because I'm from Pennsylvania. You're in Seattle. We know how to work with even without snow tires. You're like, you know what? I'm going to drive Uber for an hour, and the surge is going to be so high that I'm going to make $1,000 and do 2 rides. Cool, that's great. But once again, you already maxed out your solo K at Dell.
Right.
That said, you can still take 20% of the net earnings in this very unique example, and I guess contribute $400.
Right. Got it.
But yeah, that's the thing. You cannot double dip if you're also
Both
W-2.
traditional 401k, like if you're employed, you have a W-2 and a solo. Got it. Got it. Got it.
Correct.
Okay.
And it's kind of the same logic. Let's say you worked at two different W-2 jobs in a year. Same
Okay.
deal. The government says, oh, you worked for two companies. You just hit,
Got
you're
it.
kind of stuck at that,
Got it.
pending your age, the 21-ish to
Right.
27-ish.
Right. Right. Okay. Perfect. Well, thank you. That was very interesting.
Yeah.
So I know you're an expert in asset allocations and
Mhm.
other things. So could you please talk about what is the most invested asset with these self-directed funds?
Yeah, great question. It's real estate. And I think a good way to
Oh,
think about it is, think of our parents' generation, or maybe some of our younger folks listening to your grandparents' generation. What was big? The community bank and having CDs layered, which was basically a CD is the same product, but some would be at a floating rate, some would be a fixed rate, some would be a 1 year that every year they roll. There'd be a 3 year,
yeah. Oh, yeah.
5 year, and the old school, the safe deposit box, all of this. So in that sort of spirit, and let's just assume right now, it's the same type of real estate, multifamily value add. And I'll caveat that because I think there's a whole lot more. But just to keep it simple, let's just even say multifamily, kind of using the CD analogy and bringing it to, I'd say kind of modern 21st century diversification, as I like to call it. Right off the bat, what would you want? Well, you might want something that cash flows, monthly or quarterly,
Right?
or something that's a short-term loan that's kind of at 9 months, or maybe something that refreshes every 9 months, just like your CDs used to refresh and roll your interest
Right?
into it. That's one side to it. The other side is more of I like to think of as a development project where you're not going to get that sort of dividend. So it's almost like a balloon CD in a way. Obviously, just to be clear, nothing's FDIC, nothing is guaranteed, legally speaking. But from just kind of a very basic, okay, I have a bucket of money, and I want to earn passively. Um, how can life play out? The nice thing about real estate versus, say, the world of certificate of deposits is your principal in many of these deals, in case you're doing a straight loan, very likely is also going to appreciate, is going to go up. So, from a very basic standpoint, that's just one thing to consider of the deal structure: when you're getting paid, how you're getting paid. Is it
Mm,
regular, or do you have to wait to the end? Secondly, I think here, much like with, say, a stock portfolio, so how does this then translate to the private world of real estate? You have different asset classes. You have different sponsors, meaning different people that basically manage the deal, that own the deal. So, for myself, I have self storage in Indiana that pays me every quarter. That's awesome. This group's out of Philly. I know them, love them, trust them. They're great. And it's in a portfolio. So I'm getting that kind of diversification per se. A check I wrote yesterday was on for a plot of a short-term land loan in the Corpus Christi area of Texas. That's going to pay me I'll bump it up to 100 for simple math. If we go a year, that 100 becomes 120. If we go 15 months, it becomes 125. So 20% annualized. So,
nice.
in my mind here, I have a pretty good idea when, things are going to go full cycle or turn. So on the latter, first quarter of 2024, I'm probably going to have to reinvest. Just like a CD that has the super hard dates, you have to have a little more flexibility in these real estate deals. And in the storage fund, let's call that a 3 to 5 years, so between 2025 to 2027. Cool. You kind of have a good idea, and this is backed by real estate. And I know we're talking retirement accounts, but let's say if one of this pieces is with your piggy bank checking account, you're going to get much more benefits than you do with a CD, with the bond, with the stock. Um, and the latter, those I'd say common products that we all grew up on, you get, you're going to get charged for the interest you receive, even if it seems very small these days. So, in terms of, that's another thing too, is without going too much in detail, it's what's the net payout. I always think, if, say if I invested $100 with you today, when does money come back? And then come tax time, what is likely what I'm probably going to see?
Right.
So how much net money is coming into my pocket? And then, all else equal, let's say you have $1 of cash and $1 of retirement, you can kind of choose which one you're going to invest in.
Got it. Got it. Thank you. And are there any tax advantages for investing in real estate in syndications from your retirement funds?
Yeah, there are. The nice thing I like to think of is look at, the beautiful trees in my park here in Austin. Is the whole sea versus tree analogy. And this makes a lot more sense when you're talking Peter Thiel or the next Facebook. But let's say you have a Roth, you have
Okay.
post-tax money already, you've already paid the government. Listen, anytime you want to pay the government, they will gladly take your money. So my point is, for example, if you can pay it on 100,000 today, your gross income goes up by 100, but then fast forward, say 20 years and it's $1 million. That's awesome. If I end up back in the Northeast in Pennsylvania or New Jersey, I'll be very happy that I did a Roth conversion in a state like Texas and only paid, in my little example here, taxes on 100,000 federal. When then I go back in the Northeast and, you name it,
State
every sort of
taxes.
tax,
Yeah.
that's all my money because it's already in a Roth. So I share that as one strategy. And yeah, it's great if it's the next Facebook and it goes 100x. But even if it's, I'd say, a conscious, um, the multifamily world better than me, is, hey, we're going to go in, we're going to roughly double our money in 5 years and look to do it again and again. Like, that can really add up. So
Right.
that's great tax benefits. A similar thing is, as I said, much like in your W-2 job, you're not paying taxes as your account goes up or goes down, et cetera. But the nice thing about real estate, and let's take some, highly secured notes and such, generally speaking, you're probably going to get paid. You're probably going to get paid what you expected in the same time. You're just deferring taxes. And then, like anything, you turn 65, for example, you choose not to work, and this is your main source of income, and you're going to pull out $1,000 a week. Okay, well, better than what you're paying in taxes now as a six-figure W-2 earner.
Right.
So
Right. Right.
there are what you're not getting depreciation, other sort of benefits that might come through the different write-offs that you see through real estate. But once again, there's different reasons why the sponsor does that, and some of these do trickle down ultimately into the net payout upon sale.
Got it. Got it. Thank you. And for our W-2 earners, are there any tax strategies to reduce the liability today?
Yeah. So as I said, what I would lightly suggest to folks that are thinking of dipping their toe in the water, I would go into a deal, real estate, let's say with your piggy bank checking account, that you can see how a K1 looks vis-a-vis if this was invested in, in a corporate bond paying 4%, for example, and then you're getting a 1099 at the end of the year, which is different than the 1099 that you would get from, Uber driving, et cetera, be qualified self-employed. I just want to be clear without going too deep in the weeds on the tax side. Yeah, so in short, yeah, there are a fair amount of benefits that, depending, let's say you also own a rental house on the side, there's certain things, or your spouse, he or she is a realtor, so it would be termed a real estate professional, which is an official, tax term. Huge sort of benefits by also being invested passively in some of these deals that trickle down that you would not see, in an IRA account. So as I said, having also, if you have the benefit and luxury to have two different buckets of money, you can really choose and strategize for what's going to be best for your current bottom line, and then also maybe, your long term, your retirement.
Got it. Got it. Thank you. Um, I'm pretty sure I'd like to do a different episode on real estate professionals, just the status. Okay, some let's go into some fun
All
topics
right.
like
Fun.
what did you learn? I know you network a lot, and I met you at BEC, Investor Conference in
Ever.
Denver.
Yeah.
So, uh, from speaking to over 500 sponsors in the last 18 months or so, um, what did you learn from them?
Yeah. And first of all, it's so cool that we can meet in our scene. And this is another thing I think why, even if you are W-2, there's certain shows that I would suggest, like Best Ever, I think is a great one. You know, since I have the bottle, the Real Estate Tax Summit, Matt Sorensen, Mark Kohler, they were in my backyard in Austin. So hopefully they come back to
Nice.
Austin, but they'll probably be in Hawaii or, somewhere like that next year. I think it's worth the time to go, especially if you are W-2. I talked to a doctor. He has a, very vibrant triplets. They're 2 years old,
Oh,
but he's starting to plan now where he wants to go. And he said, "Hey, I think I got a pretty good reason to, get you out of the house for a few days." But I think where you can either do, Matt, like learning where it's true exec ed, which, I give kudos to the likes of Matt Sorensen, or if you're looking to become a sponsor in the space,
mm,
I think our friends at Quest do a great job. Or if you really want to be a hyper expert, you're going to start owning properties. Preferred Trust out of Las Vegas, just really knows the law very well. And then, you know, time is our biggest asset in addition to health. You want that checkbook control, even with an IRA, the likes of Rocket Dollar here in Austin, Texas. So just to give a snapshot of, who to communicate. Some have in person, some don't. Some are open to one-on-ones when you're in town. Other ones are sponsoring at shows. Other ones are out there. So,
right.
with all that said, taking a step back and boiling that down, one is, your sponsor should be able to rip off kind of what I just did in terms of, oh, you're thinking of IRA funding, not like you have to go to this one. Mm-mm. They should at least know what's checkbook control, what's not. Are you a big check writer? Are you a small? Is this passive investment a one-off because you want to own 10 other properties in your IRA? different sorts of folks I would say that to talk to. So a sponsor should be also educated on behalf of his or her investors. Otherwise, and I think outside of asset class, and there's different personalities, different geographies, et cetera, but I like to draw a triangle. And what I've seen and experienced is uh, I think sponsors, although they can touch all three, I think every sponsor is either exceptional or positively overweighted in one or the other. So the first one is the rock star marketer here. And some of this, buyer beware, could be a lot of fluff, could be to bring you in. Obviously, do your diligence, be extremely careful. But I think folks that, because their heart is behind it, to educate and to, as we talked about that diversification. So Dan Hanford and our friends at Passive Investing came out of the gate with multifamily, self storage, they're in car washes. I think they're kind of ahead of the curve
Right.
versus even, deep as some of our peers, what they may choose to get into. Dan's a great provider of education, and his mantra is always, you want people to, trust you, to like you, but they have to know you first. So no surprise, rock star marketer out here. Um, next up, I call the sticks and bricks folks. Maybe you were a BRRR, you house hacked. You're a construction person. I know some great friends, they're firefighters about to hit their 20
Mm,
years. They were wise enough to do things with properties on the side. They are
nice.
super, super bright. This is kind of where they come from. And then, finally down here, my nice little collared shirt today is your banker types. I like to say from a legal way to help get you to tax zero, to structure, to understand that, have some of the foresight to say, hey, what are some of the fees that a municipality may charge next year that they're not
Mm,
charging this year? Which is actually something to be really aware of, especially in a development project, at least down here in Texas. Anyways, with that, for certain deals, it's really good to have strong structuring folks. Can you accept 1031 money? If so, did you have it for a DST or is it a tick? Very different things. What's the minimum? What's the potential headache? Has the sponsor been around the block before? So I kind of share the triangle because I feel that um, all three are very unique. And in a perfect world, I mean, you have a sponsor with three co-GPs and everyone's a rock star at each of that. Or the entity has the liberty to have built out or partnered with some other ones. But like anything, I think it also goes back to kind of your sort of needs and what you're going to get out from joining a community. Maybe you also want to be a flipper, so you want a team of a construction person, or you're at the point now where there's just a number that you need to hit monthly, or that you want to hit, or a certain level of diversification that you want to be around people that are really savvy to get you to that tax zero, to kind of share, hey, appraisal came in at 40%, we got it down to 8%. Very sort of different superpower. So I think when you really boil it down, even if there's multiple, I'd say, co-sponsors on it or co-GPs, the entity itself is kind of one of the three. And there's no better or worse, it's just to be aware of that.
got it. Got it. Thank you. And I know you are really diversified, and you try different asset classes. And what's the most surprising investment you've ever heard of someone making, or maybe yourself
Yeah.
made?
Well, a real cool one. So, full disclosure, I was an advisor, investor, employee number one, effectively at Rocket Dollar, and one of our early supporters. He was a pilot, real fun guy to be around, and he had a place for himself, I think, in the Caymans, but recognized that he had a million. This is going back a few years, $1 million 401k that he can finally tap into. And he's like, you know what? Although I can't personally benefit, I can't stay there. My kids
Yeah.
can't stay there. I can't change the light bulb. But it'd be cool that, the next street down, there's four more of my properties. And that was, boom, $1 million down. His IRA, not him personally, his IRA owns it. But it's pretty cool that your retirement is physically,
Wow.
tangibly and the team that manages on your behalf is all right there down the street. So I thought that was pretty cool. Obviously, much like what you could do with your piggy bank checking account into startups, I think is really awesome. And while I don't have an exact, Hallmark card or very fun, as I said, I've been fortunate with, even before, I'd say, what people think of as angel equity, angel loans. to entrepreneurs, to female entrepreneurs, to folks on the other side of the track that can use that money and multiply it. I
Right.
feel that's been a true like win-win-win that I think when really folks come to their core and they realize they can use some of this, let's say round numbers, you have $1 million. Um, and once again, being clear, you're not donating, but you're investing. Much like someone says, "Oh, I'm going to buy a Bitcoin or two now." Great, try it out. Maybe it goes up, maybe it goes down. Why not take 50 and say, "Hey, there's 10 startups that I'm going to seed over the next 5 years, 2 checks a year."
Right.
Or, my personal experience, a friend of mine, Hispanic female, was flipping houses when I didn't really know really what that meant, but I trusted her. So a check went out and I kind of learned a lot from her updates and otherwise. So,
Nice.
um, just a lot of things you can do with these sort of
Right.
accounts.
Right. And to be clear, when you invest, the money has to come back into that account.
Yeah, great point. So you cannot commingle with your personal. So and there's a lot of rule of thumbs. As a reference, Matt Sorensen, rocketdollar.com/learn is a great knowledge base out there. But kind of, I think, common examples for people that want to own, they want their IRA to own a property. The general rule of thumb is that you have 110% of the value. So the property A cost 100, you have 110,000, you can buy it outright. Similar scenario, property B is 250,000, you put 100 down, you do a non-recourse loan. What does that mean? If stuff hits the fan, the bank would then only go after property B, not your other retirement, not your personal assets. So once again, other sort of benefits of the IRA. And then without going too much in detail with the solo 401k, there's even some added layer, I'd say, benefits and, in a way, protection.
Wow. That's great to know. I didn't know you could use leverage too. And you can't commingle with your personal funds, but you could use that
Now,
in the
you can,
IRA.
correct, yes. And there's, once again, I would say there are scenarios where, your personal money and your IRA money can go into the same LLC, and let's say that LLC then in turn invests passively or in a house. But the big takeaway, and this is not a blanket rule, is you definitely want to have all that locked up before the first check goes out on a down payment of the house, or if your first LP check comes out. You want things to be really clear, and this is where I really suggest talk to a CPA that knows your situation very well, that also knows the self-directed space. If not, I'd be if this is your intention, you're probably going to look for another CPA. So
Got it. Thank you. So, if folks want to learn more on, and if they have a couple of accounts like company A and B sitting
mhm.
around and they want to learn more, where can they go?
Yeah, absolutely. So I'm happy to have one-on-ones with anybody. I think my calling in life is to share, so folks at least know what they can do with their money. This isn't too light. It's one lifetime. We're getting closer to that 60 age anyways. So, kind of be smart with it. Or,
Right,
you do with your liquid, why not do with
right,
your retirement dollar? So
right,
with
right.
that, LinkedIn is great. Please share that you heard Dan and Deepa and it was the best thing you ever heard in your life. And want to have a one-on-one. So yeah, LinkedIn. And folks, I'm sure you do. Everybody gets a lot of LinkedIn, a lot of spam. I don't really play in the other social media sites as much now, but yeah, share a note. Just another side, because I get a lot of blind requests today. But no, because then I sincerely will prioritize. We'll probably get a call booked within the week. And like we were talking here, it's just like on the doctor's office, boom, boom, boom. And I just kind of have this sixth sense. I think I've helped over, I don't know, X thousands of people open these accounts. And from talking to sponsors, and have seen at least nine figures of money move, maybe closer to $1 billion at this time over time. So yeah, I think I have a decent idea of at least some guidance of how you can become more educated than to make that decision.
Right. Well, thank you so much, folks. Please find Dan. Dan, could you please spell your last name?
Oh boy, we're gonna be here a while. So the easy answer is Dan K, but it's Krzyzanowski, 11 letters. There used to be an extra Z. If you can guess where it was, I'll buy you a beer when you come to Austin. But
Was it right next to the other Z?
no. So I'm not
Oh,
saying
dang
anything
it.
else. I'll, I'll give one other clue though. I played basketball growing up, and there's another recently retired coach with a name similar to mine.
So it's
So
right after the
no more
S.
clues.
Right after the S.
Strike two. All right, we're done with this. Anyways,
Oh man.
Krzyzanowski, Kryzanowski, and if you think that was tough, my poor son, I think his Gmail's like 50 characters, so he
Oh my God.
has lessened his artistic to Alex RK, and I think
Poor
that's
kid.
what yeah, nobody surprises. So.
Dan, it was such a pleasure. I really appreciate your time. Thank you so much for coming on and educating us on how to use our retirement funds better. Thank you.
Thanks, Steve. Take care.